Kia ora. Ron Montgomery from BlackRock here again. In the context of the first part of this year, for the most part, May was a much more moderate month in terms of asset returns. Global equities were broadly flat and in general, bond yields stabilised. Energy commodities were quite strong, while other commodities that are generally more tied to global activity were weaker. Precious metals also fell in May. New Zealand equities were amongst the weaker equity markets globally for May. This continues a period of underperformance dating back to the beginning of 2021. That underperformance can probably be explained by a few factors, but chief among them is rising rates, where we find the relationship between New Zealand equities and New Zealand rates to be much higher than the global equivalents. Speaking of New Zealand rates, it's worth talking briefly to the Reserve Bank of New Zealand meeting that happened toward the end of May. The RBNZ continued to be unwavering in their goal of getting rates higher in what will be an historically short time frame based on their own forecasts. The read-through of those forecasts and commentary is that they accept that to temper inflation it will necessitate some slowing in demand and an increase in the jobless rate. We continue to monitor the various exposures in the portfolios, one of which is the degree of currency hedging within our global equity exposure. As you might have heard us speak to previously, the New Zealand dollar tends to increase in value as global equities rise and vice versa, fall with global equities also. The constellation of global central bank tightening, geopolitical tension and ongoing supply chain issues lead us to anticipate that volatility is likely to remain with us for a while yet. Exposure to falls in the New Zealand dollar does help provide some inbuilt resilience into portfolios should the drawdown in growth assets continue. To be clear, markets have already factored in some of these risks. If we take some learnings out of the RBNZ meeting, however, it's that in the short term, central banks can continue to surprise on the hawkish side, and the likelihood that asset markets perform strongly with that backdrop is small. We'll continue to monitor these market dynamics and have the ability to adjust the portfolios should we think potential outcomes warrant it. Thanks for listening.